world to the property market now. We entered 2025 with the backdrop of national home values falling over the December quarter, the first negative quarter, in fact, since February 2023. So how should investors approach the market in 2025? Anthony Landahl from Equilibria Finance joining me. Hi, Anthony, good to see you. What does that tell us about the housing market as we kickstart 2025?
Yeah, the housing market's coming off the back of 18 months of pretty strong and resilient growth, but we have seen it easing in the last quarter. In fact, as you intimated in your introduction there, we've had negative growth at the end of December. So we're coming into a softening market. I think what we're actually really seeing is a rebalancing of the market nationally. The market was being driven mainly by Perth, Brisbane and Adelaide. They've been easing off. Perth was up around 25% growth middle of the year. It's back just under 20%. Adelaide, Brisbane about 10 or 11% nationally. We've had negative growth in Melbourne, Hobart, Darwin and Sydney's about parity. So I think we're seeing a rebalancing on the back of affordability constraints for buyers, and for sellers there's actually more stock on the market. So I think we're just getting a little bit of rebalance back in the market coming into the new year. We still had 5% growth nationally, albeit we've had a couple of slowdowns, and as you said, the December numbers were negative growth.
So what does that mean, or what advice would you give for investors going into the market? We had a guest yesterday saying that he thinks the best move is to actually live in your house rather than invest, but what are investors thinking?
Yeah, we're getting a lot of we're getting new investors who actually just can't afford to buy a property where they want to live. The median house price in Sydney is $1.6 million. So we're getting people who just can't afford to buy in Sydney looking at investments. The main guidance we're giving investors at the moment is around cash flow, whether it's an investor using leverage and equity that they've created over the last couple of years, or a first-time investor. I think a lot of investors, the main challenge is the cash flow. There's more stock coming on the market. I think the next 12 months there's going to be some good opportunities for investors in the right places. We're still getting some very strong growth in Adelaide, Brisbane and Perth, and there's still affordable markets in those areas, albeit their median prices are now above Melbourne, and they're around 800,000 or 900,000 in those three states. So I think this year there's some great opportunities for investors. The main thing is the cash flow. With the higher interest rates, the higher costs of holding a property, but there are definitely opportunities for capital growth, and rental yields, whilst they've come off those peaks, are still very strong in some areas, in and around 6-7%. So I think there's some good opportunities for investors with that extra stock. Cash flow, whether you're a first-time investor or building through leverage, is probably the main consideration at the moment.
Yeah. So do you continue to hold your view then when you talk about high rates that they will not move until May?
Yeah, look, I just think economically there's probably not enough there to drop them. Your last guest was talking about the employment numbers. Unemployment's sitting at 4%, which is a strong labour market. Whilst wage growth is slowing, we've still got a strong employment market. We've got a falling dollar, which is creating some inflationary pressures. Probably not all of it's being passed on because of a slight mismatch with demand. And the trim mean inflation is still at around about 3.2%. The December quarter inflationary numbers come out at the end of January, so that's obviously going to be something the RBA is looking at. But I just think that combination of where that inflationary data is at the moment, let's see what happens with that December quarter data, which will be before the RBA's meeting, that falling dollar and those strong employment numbers, there's probably not quite enough meat on the bone, I believe, to from an economics perspective, to drop to have that rate relief. There's a lot of political pressure. CBA, ANZ have come out thinking there might be a rate cut. NAB, Westpac hold a different view. They think it might be more around middle of the year, and I think probably middle of the year is more likely at the moment for those reasons.
It's sort of like throwing a dartboard, isn't it, when you've got the big four split and I think AMP somewhere in the middle. A quick Question on rents. Are they starting to, rental yields coming down?
Yeah, rental yields have come off that peak. Again, we had a subdued period of investors. Investors were out of the market through that high increase in property prices and high increase in rates. Investors are coming back in the market. So what we're seeing with rents is the migrationary numbers have eased, demand has eased for rentals, and there's also more stock coming into the market. Essentially what we're there seeing is an easing in some of that demand and that frenzy around rents, and we have come off the peak of those rental prices, albeit rental yields are still strong, but that real peak in those vacancy rates below 1% have absolutely eased up, and that's nationally as well.